Rocking in the free world. Monday, Nav 21st. I just like saying Novi, Nav. I mean, it's all good. Guy Adami here. Dan Nathan there. In a brief few minutes, Carter Braxton Worth of Worth Charting. Today's market call brought to you by FactSet, financial data and analytics that are powered by tomorrow. The New York Jets were not powered by anything yesterday other than their defense. And now listening to Jet fans whine, oh, they missed a call. You know what, people? Stop it. You got embarrassed once again in New England, 14 in a row. That's 7 years for you playing our home games. How are you, Dan?
I'm doing well, Guy. I mean, it seems like what did they tune into the fan this morning? Is that what's going on?
No,
here
but
on
I just,
Call?
It's like they whine and they.
But it's interesting that you didn't even mention your 7-3.
No, Giants got beat. Yeah. Both sides of the football.
Yeah,
offensive line got beat. Their defensive line, which is the strength of the team, got beat. Yeah. Lions under Dan Campbell, who was a Giant, by the way, playing some decent football. That's a young, exciting football team. They'll find a quarterback at some point. The defense is getting better each week.
Yeah. All right. Let's say a couple things that are not getting better each week. And it really is some of the most speculative stuff in the markets, Guy. I mean, we were talking about it before we came on. I mean, it really feels like on a day like today, it really feels like some of the stuff that people were most excited about a year ago, right, is really looks like it wants to close on the lows. And when you think about charts, and we do a lot of charts here, we're gonna have Carter talking about charts. A lot of things are literally in the opposite corner of the chart of where they started the year and going lower. And I'm just gonna name them here. I mean, look what's going on in crypto and related equities here. Look what's going on in SPACs. Look what's going on in meme stocks. Then look at the meme stock of them all. Tesla is down more than 5% today. This stock is being used as a proxy for Elon Musk right now. It's being used as a proxy for what's going on with Twitter. And if I'm a Tesla shareholder, I'm absolutely rip shit, man. And so I actually think there's other shoes to drop here. But just look at this thing, Guy. It's kind of moved into this zone. And one of the reasons why I wanted to highlight this area here is that on November, I think it was November 15th of 2020, so the 2-year chart. 2 years ago, the S&P announced that Tesla was going to be going into the S&P 500 index. This is even before it happened. The stock nearly doubled over the next month and a half or so. And so that's why I think round tripping to that 140 level from November of 2020, when that announcement was made, I think that's likely to happen. And again, you and I have been talking about this. Carter's been talking about it ad nauseum. This is one of the worst looking charts in the market that's down nearly 60% from its all-time highs a year ago.
We've tried to do a good job, and I think subsequently we've done a decent job navigating. The first time we said, listen, Tesla should trade down to 175 and bounce. It actually did exactly that, traded down to 175 and changed, bounced close to $200, and then we said it's probably going to then test 175. This time it's not going to hold, and the real support level comes in probably around 150 or so. I think your line is actually lower than that, but here we are. So you say what you want about Tesla, but stock has not been trading particularly well. And it's now down probably, close to 60% or so from its all-time high. Yeah. So that's finding its way into a lot of these other stocks have been taken out to the woodshed. A stock where valuation didn't matter to anybody seemingly matters now. So, I think Tesla under pressure, and you've mentioned this before, and I agree with it. I think this is a important overall market sentiment stock. And obviously with this trading the way it is, doesn't augur particularly well, I don't think, for the broader market.
Well, yeah, and again, I mean, this is the biggest meme stock that's ever existed. It had over $1 trillion market cap, a year ago, and I think again, it's being used as a proxy for multiple different things. The cult of personality, it's a term that you used really well in our podcast on the tape last week a little bit. But think about this. I mean, we're seeing things get unwound here in the crypto space with some really big personalities, and I think Tesla is actually reflecting that for the Musk universe right now. Another part of that, you can't talk about Musk and Tesla without talking about ARK. And look at this thing, man. It is literally listing here. If you look at some of those top holdings, Tesla's now number 2. Zoom, we're going to talk about in a few minutes, Guy. They report after the close tonight. I mean, look at these stocks that make up this ETF. And again, why is this important? Take out those lows from 2020, those pandemic lows. This thing's in a free fall here. And obviously, one of her biggest holdings in this thing is also Coinbase. So again, why are we talking about all these? Because the speculative stuff, the air is coming out right now.
There's a good line. ARK going 30,000 leagues under the Red Sea. I love that Jules Verne shit, by the way. I read the books as well from time to time, Dan. Now, and listen, we're not picking on Kathy Wood. And, this is an ETF. So they are subject to people getting out of their ETF. And, the most innovative thing about the ARK ETF, and I've said this on Fast Money a number of times, was when they created the inverse ARK ETF, because they top ticked it. And say what you want about Michael Burry, who I think it was last summer, so about 16 or so months ago, if not longer, pointed out that one of his favorite shorts was exactly that, the ARK ETF, and then subsequently Tesla as well. He basically nailed that one.
Well, it's interesting. David Wilson in the comments saying, what about celebrating a new car company that beat the odds? Well, they did beat the odds. They got to a point where they're making and selling 1 million, cars a year, which again is a monumental feat. But what's going on in the stock market right now is saying that there's risk to actually Elon Musk running this company. For him to buy Twitter, he had to sell a lot of his Tesla stock. He probably had to margin a bunch of it. He had to take on a bunch of personal debt to the tune of nearly $13 billion. So what do you think happens if Tesla starts missing their numbers? If we have a recession, okay, this company starts mis-executing because their CEO is focused on tweeting memes all day, okay, on Twitter, okay? So that's the point. That's why Tesla is important here. And again, if you want to start celebrating this company because of what they've been able to do over the last 10 years, that's fine, but it doesn't really feel like it's something that's investable at the moment. Another thing, guy, that doesn't feel particularly investable is Coinbase. You think about this, our friend, he's the Wall Street cynic on Twitter, but Jim Chanos, he's been short this thing for a while. He's been very public about it. He's thought they've had a whole host of issues here. I just drew some lines on this chart, man. I mean, this thing's about to make a new all-time low, and the fear, guy, right now is really contagion, right? It's FTX to Binance to Coinbase.
I don't think it's over by any stretch. I mean, again, if people want to say it's contained, it's always contained until it's not. And I think it's probably somewhat farther reaching than people want to admit or willing to recognize. And in terms of Coinbase, I love Gene Munster. I mean, he talks about it all the time. And he mentioned Coinbase as potentially being the bank of the metaverse. And that was a while ago. And that might come to fruition. But the metaverse is at least 10 years away, if not longer. So by definition, it's probably going to take Coinbase about that time to sort of get its sea legs. And there's no real compelling reason, in my opinion, to be in this name. And Jim Chanos has been right, and he'll continue to be right. This is pretty critical support, but it doesn't feel particularly good here. And, I guess the way you trade this, maybe if you want to play the breakout through that downtrend line, but I think the more reasonable assertion is it's going to break support in the near future.
Yeah, it's pretty interesting, guy. Here's an $8 billion enterprise value, so $9.5 billion in market cap, $5 billion in cash, and about 3.7 in debt. And I guess the question is that they have a huge burn. So if they have to start firing employees, that will take the their cost structure down a little bit. But who knows? What's up with the USDC? That's their stable coin, right? What's up with related party transactions with other, Grayscale. This is another one you keep hearing people talk about. This is just, again, this is something that you and I are not going to be able to figure out what's going on here, but we've been around markets long enough to realize that you just don't uncover one fraud like this FTX and this FBF thing. There's a lot of other stuff that's going to go on here, and let's just hope it doesn't find its way into the regular markets. But when I look at the market today, all the markets today, guy, I see just risk aversion. I see, again, all of this stuff that was the most speculative stuff a year and a half ago trading really horribly. And that's the sort of price action that has the ability to move into the major indices, which could be a really good opportunity to bring in our main man here.
I love Carter Worth. Let's bring him in. CB Dubs, you've heard what we said. Obviously, this is a holiday shortened week. So weird things can happen. Typically on these weeks, you have low volume. Markets typically levitate. Not happening yet. What are your thoughts here? Does that hold any credence water whatsoever? Carter, his first day here.
Oh, yeah, look at this.
Call.
Look at this.
Look at you.
I had my old cautionary mute the button in case I was, I don't know, burping or something.
Bud.
Here I am.
Welcome, Carter.
Thanks, guys. Yeah, I was saying, look, there are stats on this. I mean, it's not really statistics, it's data mining. Holiday shortened weeks, in particular Thanksgiving week, is quite often positive, which is to say big money's away and people move things when the illiquidity is there. But the overarching theme is that the market's picture, that is the S&P 500, tells one thing, but the underlying constituents, the components, the arrangement of the parts says something different, right? And that we've had a lot of heavy lifting from big sort of old-fashioned names, whether it's Honeywell or DuPont, whether it's big banks like JP Morgan up 30 or Goldman Sachs up 40% off its low, that have allowed or permitted or kept the market from really sinking. But the internals are not good, at least by my work. And what we know also is this: it is a 100% consensus view that we are going to trade up to a moving average, the 200-day moving. All the world's become a technician. We're going to 4,100 and some number, perfect like that. Listen, when everyone believes something, it's not likely to happen. Either we're going to overshoot that and go to 4,400, or we're never going to get there and we're sinking to the lows. But just that it's going to go right there. Charts are perfect. We're all technicians now, and then it's going to fail. It doesn't work like that.
Carter, what do you make of just some of the commentary you heard from us when we're talking about, again, I mean, the list goes on. It's crypto, it's meme stocks, it's unprofitable recent tech stocks. I mean, the list is going on and on here. The price action is really bad.
It is bad. And also, again, what I would say is a part of what's bad about it is that you've had what I was just referring to as these heavy moves, that the capital that's come out of these other things has gone back into the market in the form of DuPont. Think about DuPont is one of the oldest companies. They were selling gunpowder in the Revolutionary War. And for it to be up 30 and 40%, along with others that I mentioned, whether it's Boeing or GE, they're not in a better position now. They're worse. So you have two sort of areas. You've got things that are sick and getting sicker. That's Tesla. And then you've got huge ricochets, which now, despite the fact that someone made that money, and one could say, well, thanks, Carter, why didn't you call for those bounces? It's not about that. Now that the bounces have happened, these stocks are not in a good position. They're actually positioned to either pull back or give back a lot of what they've done, so that the market's construction is actually worse. Those heavy lifters have prevented the market from going down as the sick have gotten sicker. Tesla's getting sicker, ARK's getting sicker, coin is getting sicker. And now, if and as those DuPonts and Goldmans and Boeings give back, the whole thing then goes lower, SPX lower.
Let's take a look at the heavy lifters, the Apples, the Microsofts, the Googles, the Amazons, and the Teslas. You brought in, you always bring great charts, but I love when you do stuff like this, because a picture, as they say, is worth 1,000 words. And what this tells me is those stocks are starting now to underperform. What does it all mean?
That's right. And so the key here is we all know that equities in aggregate, both in the United States and globally, have a June low. And we know that almost all equities rally from June to August of 2 months, not the Zooms and DocuSigns, but everything else. And then everything goes down to the October low and basically has held, broke, or come back above, but not the big ones. And so this basket is about 19% of the S&P 500, these five. And it represents about 9 trillion or thereabouts. And look at that divergence. Now, if we pull this back, that's a 1-year chart. Look at a 2-year. And so now they're kind of back in touch with one another, right? The great overshoot by the gods, and now 2 colors, 2 lines, S&P. But what we really know is that it's the relative underperformance of these big heavy ones. And the only reason the market is not gone lower is because of the moves in DuPont and Boeing and GE. But that looks like that's run its course, I guess is my point.
So Carter, let's talk about some of the individual names though. Again, Apple is one guy. We were on our Fast Money call a little bit ago, and he said it acted like a 4-letter word today, which I think is really which I think is pretty interesting. But that stock is only down 16% on the year. We know that Google's down 33%, Facebook's down 67%, Amazon's down 45% after a big rally. Google's down, you get the point. I mean, Microsoft's down 27%. This one, we've focused a lot on Apple, because it's the largest market cap company in the world, and it seems to be one that has shown good relative strength for the better part of this year. It's had this nice little rally here. But if all of the things, all the reasons, the macro are weighing on equity valuations, at some point, doesn't this one have to kind of retest those lows from the summer?
I mean, obviously it doesn't have to, but I get your sentiment, and I'm with you, meaning in and of itself, it's a pair of twos, right? I mean, if you didn't say Apple in there and you just got a surprise chart, what is this? You'd say, well, whatever it is, I'm not that interested in getting long or getting short. It's kind of stuck. But we also know that if you look at the precondition, not depicted here, which was a great period of strength, which makes the chart we're looking at something else than a pair of twos. It's the beginning of a rollover, right? And that's really what we've got here. And I think it's important to say this, that basically before COVID, right? Forget about earnings per share, because that's something that is reflected in shares outstanding. But I mean, Apple's net income, the actual just billions of dollars it makes, was the same in 2015 as it was in 2020. 5 years, no change. It was COVID, right, that allowed for the net income to double and triple. And basically that's overdone.
Run us through some of the charts. We saw the first one up, but you obviously had a few more. You put some lines, as you like to say, the lines in fact draw themselves, although in this case you drew them for us. Continue to speak to us about this underperformance of the big 5 or 6 names relative to the S&P.
So here is then now not a comparative chart, but just that basket. Again, this is about 19% of the S&P, these 5. And the issue here is, of course, I mean, you could draw that as a head and shoulders. It's otherwise known as a bullish to bearish reversal, but it's just how bad it is and how far below the June low. That's the issue. Whereas the S&P is, of course, above its June low. I'm not sure we have another one here. I'm not remembering, but oh yeah, there we go. So let's toggle, right? Moving average, trend lines, moving average, trend lines. And what we've got is a clear break in trend. Doesn't matter how you draw the lines. And so even if it were to recover, typically, and you see there, it tried to recover. Guess where it stopped? It touched the underside of the line to the penny and failed. And now here we are. It's just a bad situation. And one could say, well, why isn't it so bad it's good? It just doesn't feel like that to me.
Mm-hmm. Yeah. Well, it's interesting, Carter, as we've seen this underperformance of those major names. And again, this is something I think the three of us have been suggesting for the better part of the last year. At some point, they're going to get to these. You were calling them the generals. They shoot the generals last. Well, they've done that. That's why I brought up Apple in particular. But as money has come out of those, okay, we've seen money move to other places. And one of the consensus trades, in my opinion, and it was working until very recently, was energy stocks in particular. And, you mentioned on Market Call on numerous times, and you have on Fast Money too, that we also have seen a big divergence between energy stocks and the underlying commodity. Talk to us a little bit about this call, because again, I was with you on crude and also the XLE here, but it seems to be today, while they were bounced a little bit midday, they were looking pretty nasty earlier in the morning.
Yeah, I guess there was some headline about maybe talks with Russia about who knows what, and crude was down. Now it's recovered. But this has been going on for a while, right? And more importantly, independent of a trade in crude, and it's excellent to trade crude on the NYMEX if you can, it's the shares market, right? The S&P 500 energy sector, the Russell 3000, 2000 small cap, mid cap energy names. The underperformance that's been in effect for the past 2 weeks is serious business, only because it's coming from a period of such epic outperformance. And I just think you want to be underweight energy. And it's an important thing was very crowded that now is just not right to be there.
Let's take a look at the oil chart then, because you brought that along with you. I mean, again, it's great to see these things with lines and those types of things. You've said for a while that the uptrend line was in play. Here we are, seemingly now have broken it. You've outlined what appears to be the potential for a head and shoulders. And if I'm correct, the measured move off of this is probably around 60 or so bucks back of the envelope.
I think that's right. I mean, we certainly know that the key reference point one is that we've broken below that intermediate low of just a few weeks ago. But more importantly, we're now toying with the autumn low of 2021, right? So that takes you into the low low 70s, and why not?
Take a look at, the GSCI is something, I think it's a GSCI you have as well. And this is at pretty critical levels. I mean, you look at this, a significant uptrend since I want to say the middle of 2019 or thereabouts, in jeopardy. And when this is in jeopardy off a trend line of this duration, that speaks to potential. That's potentially problematic. Now, I think a lot of this is on the back of China concerns and those things. Doesn't really matter the reasons why. Here we are.
Yes. So the issue here, and it's a serious one, is that this, while heavily weighted towards crude, is a basket of all commodities. And one, the trend line is pretty straightforward. And I've tried to highlight it by putting arrows there, but one doesn't need that. I mean, and look at the channel. That's really the more important thing. The channel is where we went nuts, right? Because crude oil and the Ukraine attack on Ukraine accounted for that blowing out through the top of a well-defined 45-degree angle. But now not only are we back into it, of course, we're at the lower band. And one could say, well, why not play for a bounce? But in general, if you look at copper and you look at some other key commodities, they all are pretty heavy. I think here and now we undercut the lower band.
Yeah, and let's take a look at OIH if we can real quick, because
Sure.
we obviously we had that huge downdraft. Now this obviously, if you put up an OIH longer-term chart, I just want to sort of walk through. We traded up to about 317 or so in June, cratered down to 2.25, bounced, cratered back down to about 215 or so, a little bit of a double bottom. This move up has been incredible. You're talking about, I want to say, a 55% move in a month, but we traded to and seemingly have failed at the highs we saw earlier this year, spring, summer. But today, obviously the downdraft, if this were to close positive today and it's still down almost 3%, does that mean anything, or is this broken here, Carter, regardless?
Yeah, I mean, it's so important how you close, of course, because reversals intraday are real. And think about the sentiment that if something is especially weak and under pressure, but it fights it off. That's the entire premise of the Rocky Balboa movies, meaning if you take a blow and keep standing, it means that there's such underlying strength that it has to be respected. So it's why the close on any given day is very important. And a reversal after extreme weakness intraday and closing in the green is literally Rocky Balboa stuff. So while we can't know what the close is, that would be a very constructive conclusion to this very unhappy session. The odds of that happening, though, are exceedingly low. That's why it becomes a good movie, because while it is interesting, underdog, they don't really happen that often.
Yeah, that's a fact. I mean, it is interesting. You mentioned something with Russia. It was the headline. It was, I guess, a story in the Wall Street Journal talking about the Saudis raising their oil output. The fact that the Saudis come out and say they're not doing that, you see the price of oil come back up. I could definitely see them doing that, Guy. Couldn't you definitely see them doing that at some point, probably after maybe the World Cup is over in Qatar. But again, I mean, if the market, which was down a lot, this is oil and then oil stocks, which had that intraday short covering rally, if it does head back towards the lows, I'd say you keep selling rallies and energy stocks and the underlying commodity here. So again, that's an interesting one to watch. I would also mention, if we want to throw up the 10-year yield, given everything that we're talking about, today, look where the 10-year yield is. It's 3.82. It really hasn't gotten anything going. And I'm just curious, Carter, your thoughts on that, because once we broke 4, it felt like to the downside. It felt like the fever kind of broke here a little bit. And I'm just curious, thoughts, because, as we get to the first week of December, we're going to have that November jobs report. Then we're going to have the Fed meeting and the CPI data or whatever. We know how explosive, we saw that move, that one day 30 basis point move lower, right, after the CPI a week and a half ago. What is this chart telling you? It's broken that steep uptrend since August. 3.5 seems like the next point, and then that rising 200-day, is probably somewhere around 3.
Right. So if you consider the June high at 2.5 as a reference point, and you were to draw a horizontal line along that over to the y-axis, what's also very drawable is connecting the lows of the past 2 years, and the uptrend line that you can do that with your eye goes exactly to 2.5 as well. And so I'm in the look. I just in the camp of lower dollar, lower yields, lower oil, lower stock prices. There is a consensus somehow all those things add up to higher stock prices. That's true until it isn't, and lower yields, and it doesn't have to stop at 3.5 the June high. There's not a lot of reference there. It's just one reference point.
We have to talk about Disney, but I just want to sort of amplify that as well. I mean, 2s10s, I think, got north of 70 basis points inverted at one point, and we've said for a while that there's a very real chance that 2s10s go to 75 basis points, if not 1%, in the form of 3.5% in the 10-year, 4.25% in the 2-year. And it's pretty remarkable. We're precariously close to that. And again, I say it all the time, I'm not an economist, but that does not look particularly bullish to me in terms of what it means for the economy. Anyway, Dan, Disney is front and center, everybody's mind. Big news over the weekend. Yeah. We're going to have Tom Rogers on CNBC's Fast Money tonight to talk about this, but Bob Iger is making his return.
Yeah, this was an interesting one. And again, I remember asking Carter on Market Call what he thought about, kind of taking a small, long position into the print, thinking that you were going to have a really good shot to buy it, okay, with an 8 handle on it, okay? So it was trading, I think, at like $98 or so. And you said you didn't like it. And we had that huge gap lower. I kind of bought the gap. And I remember you saying, okay, well, you're just kind of, you're flipping a coin here a little bit. And I think without this piece of news today, it was kind of interesting. It looked like it really wanted to retest those lows. Carter, my sense, is that, again, while a lot of investors and analysts and, strategists or whoever are kind of happy to see Bob Iger back in the chair here, it doesn't really change the technical story because it's not going to change the fundamental story for a bit. And I'm just curious your thoughts when you see the pattern. I drew these lines. You could say they're good, they're bad, whatever. They seem pretty simple to me here. The stock basically failed at that downtrend that's been in place since the summer. And now we just have to see if it fills in that entire gap. And if it fills in that entire gap, back this thing out 5 years, and you really are going to start focused on, will it retest those March 2020 pandemic lows?
Right. I mean, this is a case of always where one starts the meter, right? Or where one starts the story. Like you come to a movie late, you sit down, you miss the first 20 minutes. Look, the headlines read as follows in every single news wire around the country. Disney jumps, Disney surges, Disney rockets higher. Okay. How about something more calm? Disney, down 57% from its high on Friday, is now down only 52% from its high. Now that's the reality. There is no surge, there is no jump, there is no rocket. All it's done is gone back to where it was 6 days ago. It filled a gap, and that's that. Nothing changes. No one's a god, despite even being, is Eisner better than Iger? Iger better than I? Listen, he's not going to change the fortunes of this.
Just to be clear, I want to be clear. Bob Iger did probably something that no matter where the stock is, people are going to be talking about for a very long time. The buy of Pixar, the buy of Marvel, and the buy of Lucasfilms. And I go, Guy, you've seen the whole catalog of all three of those. It is really remarkable. Can you think about what this company would be like if it did not have all that IP? So I think that's amazing. You could say they underpaid for those and they overpaid for many other assets. Guy, I'm just curious, like what you think is like, I bought this stock. Okay. I bought it somewhere, below 90 here. I took a little off as it rallied quickly after that CPI print. It had nothing to do with the fundamentals. I feel like I kind of got one quickly. Is this one that you want to be averaging into if it were to come back in a little bit? Does this piece of news change the story for you kind of in the intermediate term?
It's hard to come back. I mean, but he was the right guy for the job at the time. He was probably the right person to remain in the job. Chapek was an uninspired selection. If you read the article, and I think it was a journal over the weekend, it sort of outlines that a great deal. And he got himself in a political wrangling match with the governor of Florida, which didn't work out particularly well either. So a lot of things working against him. But I'll say this, and I think you would agree, in terms of valuation, Disney is cheap to itself historically. And I think when the world finally does get back online, and it will at some point, Disney will win to that. They've made some mistakes without question, but you can make a decent case on valuation. The last quarter was not particularly good. This next quarter, as my sense is, it won't be either. But this is a company that I think can get off the mat from the 85 level that we saw, I think, a couple of weeks ago, but this 96 level or so that's trading now as well.
All right, let's do one thing before we get out of here. Maybe we'll get your fundamental take and Carter's technical take. Zoom reports after the close today. This is a stock that's down 56% on the year. It's down a whole heck of a lot more from its all-time highs. This thing started correcting, I think, in late 2020, if you think about it. So this was the ultimate of the pull forward sort of stories. The line I drew is just basically, that's basically the gap level from its IPO a few years back prior to the pandemic. pandemic here. So, you see the support. You tell me if the support's any good. Guy, what do you think of this thing, though? Trading right now, this is a company very different than many of its kind of recent tech IPO peers. They actually have real profits. So this has been a profitable company when it went public. It's profitable now. It's just a deceleration of that profit growth, and that revenue growth is the most important thing. Trading about 21.5 times this year, 23 times next. I mean, is this thing one more gap away from being interesting to you from a fundamental standpoint? This is a company expected to do $5 billion in sales next year, let's say, give or take. That's got one product. So to me, when I think about the enterprise value of a company like this, and I say the utility of the product, and it is far better than most of the other competitors out there, I say, Guy, I don't know, could this thing be a takeout candidate if we were to have one gap lower?
Yeah, I think for somebody, it probably makes sense. I don't want to say it's necessarily a Microsoft, but if somebody's looking to play in that same arena, that it makes a lot of sense. And to your point, is it one gap away? Carter will probably look at this and say pair of twos. I agree. Maybe we trade up to 200-day moving average post earnings, but I think more reasonable is to think we take a look at that $70, which I believe was the latest 52-week low we made a few weeks ago. So I'd rather wait. Trading it into earnings to me is a flip of a coin.
Yeah.
I'd rather look to buy it on a dump down to $70.
It's a coin toss. I mean, I there's nothing in the pattern that would suggest it's. I'm sure the implied move is huge, of course. Why wouldn't it be? But there's nothing that I can see that would say, hey, this is a 60-40, this is a 70-30. We've got to bet short or long.
So Paratus, one of the things I just say this real quickly is that this company went public at 36. It opened, it was a double, okay, when it went public in April of 2019 on the opening, and that's that line down there at 70. They sold nearly 6 million shares. You ready for this? At $340 in January 2021. That's why they have $5 billion in cash on their balance sheet and no debt. So this is one at a certain price, makes a whole heck of a lot of sense. It might behoove them to just kitchen sink the thing and just get all the weak hands out of there. So, all right, that's that. I appreciate it. Guy Adami.
Yeah, we got to pull up this comment from JS. I love this. This just goes to show you our viewers and listeners, or they think the way I do. Maybe Disney comes out with a co-branded weed will be the final sign that our society is lost. There have been a myriad of signs that our society is lost, and that absolutely been one of them. But what can I tell you? Anyway, Carter Braxton Worth, always great to have you on this holiday shortened week. That's it for Market Call. Thanks to FactSet for providing us with all of the charts and data you see on this broadcast. We'll be back tomorrow, 1 p.m. By the way, Dan, I believe that EY from SoFi of the now probably playoff-less Packers will be joining us as well. And I got to tell you something. Her Milwaukee Bucks, although playing good basketball, they've put in some stinkers as well. Maybe we'll dive into that. What do you think, Dan?
I think we most likely will if you're going to be hosting the show. So tune in tomorrow for that. And Carter, thanks for sticking around here, man. Thanks for all the fine work that you do. People, you know where to find them. It's worth charting. There's nothing slick. Straight. It's just charts.
What did I say? What was mine that I came up with? I really liked.
Oh, yeah, what was that?
I don't know. I'll think about it again. Maybe Amanda can put it in.
Not safe for work, probably. All right.
No, it was good. No hearts, no emoji hearts. Just that's it. No emojis with hearts, just charts. I like that better. Anyway, enjoy the rest of your day, folks. We're at 5,000.
Thanks.